Hi, everyone. This is Dan Girard, Managing Partner at G9 Financial, coming to you from our offices in Millbury, Massachusetts. Coming to you today with guest speaker Michael Laughlin, a CFA with Morningstar Wealth. Morningstar is an investment strategist that G9 utilizes for some of our client accounts, and Mike heads up their Morningstar portfolio strategy team. Today's goal is having a conversation with Mike more around the current state of the economy here in November of 2024. Obviously, we've had a lot going on with some political upheaval, we'll call it, in a good and bad way, however you may look at it. But wanted to get an insight from Mike and Morningstar of what they feel what's going on in the economy out there today and how does it look going forward into 2025. So with that, Mike, I appreciate your time and I look forward to chatting with you this morning.
Yeah, it's great to be here, Dan. I really appreciate the opportunity and look forward to this as well.
Awesome. Thank you. So with Mike, with that, obviously there's been a little bit of political upheaval, as I like to call it. We have a change of president coming in. Some people think it's good. Some people think it's bad, whatever it may be. Just your thoughts from Morningstar. What do you guys are thinking what this change may create?
Yeah, it's one of these things where it's hard to think of two things today that are more emotional than money and politics.
Sure.
And I do think that mixing the two there's a lot of allure to that. It's easy to do, but I would caution against it. I really would. I think what is most important is that you have a long-term financial plan, relative to the goals you have, and that you are sticking to that plan. I think, I'm happy to talk about some of the policies and the market environment, but I think one big takeaway is I think a client is far more likely to do long-term impairment to their portfolio by trading around, let's say you did not support Trump, by trading around the election than just riding through and the policies that you may not be a fan of actually impacting your portfolio. So if that makes sense, I think taking action, big action here, saying, oh my God, I better get some or all of my money out of the market. I think that is a far more likely to be a long-term mistake than just riding it out.
So Mike, what I'm hearing you say, and we talked a lot about this with the clients that we work with, I sit at that table and have clients sit there and we got to go through their financial plan, is whether you like it or not, it's not building a plan to get away from it. It's about building a plan more likely to get through it.
Correct.
Would that be safe to say? Which we wholeheartedly agree with, because we don't control what's going on outside those windows or that nice window behind you for that matter, right? That's out of our control. But what we can control is our own journey and how to build strategies to get through that process.
Yeah, and we can look to some historical context. So, in presidential election years, if you go back to the 1920s, the worst 2 months during an election year are September and October. Sure. And this kind of makes sense because, there's an old saying, the market can only focus on one thing at a time. And in September and October, it starts to focus on the election, right?
Absolutely.
And it's kind of, the market doesn't like uncertainty, and that's peak uncertainty, especially kind of in this election cycle where, at least heading into the election, it was pretty much a coin flip, right? The best months in an election year historically are November and December. And the reason for that is because we have the election, that uncertainty reveals itself, and we move forward. Also, interestingly enough, the best years, if you look at, again, through the lens of elections, the best years for the market are when there is no election. So basically the odd years, right? We don't have a presidential election. We don't have midterm elections. The odd years, like we saw in 2023 and we will see in 2025, historically are the best years. And so, again, at least viewed through this lens, and that past performance is obviously no guarantee of any repeat, but traditionally the period we're in right now, and then heading into a year like 2025, would generally be above average return years. And again, I think the danger is overreacting to this outcome and changing your asset allocation or changing your portfolio. If, for example, in our model portfolios, which we can certainly talk about, if we looked at our 60-40 model today, it's basically bang on 60-40. We're not overweight equities. We're not underweight equities. It's just kind of keeping the ball down the middle of the fairway, taking these great returns that we've gotten in the short term here. We still have overweights and underweights areas that we like in the market, but we're really just not taking huge swings right now. And I think that might be, kind of the number one takeaway I would share.
Yeah. And it's kind of stay on goal, right? Stay on task.
Yes, correct.
Yeah.
Yep.
And again, that's controlling the journey. And we talk about money now, soon, and later, and sticking to those game plans of conservative bucket, a moderate bucket, a more aggressive bucket, and let them do their job over time. Yeah.
Yeah.
No, that's great. Perfect. Great. So Mike, if someone's, really concerned, what should they do? I know what they should do, but I'd like to hear what your thoughts are.
So yeah, I would say, sort of what we just stay the course with the portfolio. I think if we look at the broader, let's say, macro picture in the US heading into 2025, our view is pretty optimistic, honestly. Growth is reasonably strong. We might see it, trough a little bit, but growth is reasonably strong. Inflation is coming down. And the last mile of inflation, let's say, if we're kind of in the neighborhood of like 2.4, getting it back down to like bang on 2, that last mile is always going to be the hardest. But we've come down a long way from sort of the peak inflation that we saw, in the summer of 2022, let's say, right? So we have been winning the war on that front. Unemployment looks reasonably good. There's been a recent small tick up in unemployment, but it's actually been driven, in our opinion, more by increased supply of labor. If you look at the level of layoffs in the economy, which is important because if I'm laid off, then my consumption is going to change, right? Maybe I'm not taking trips. Maybe I'm not spending money at restaurants. And then, that impacts somebody else's job. And that's where that kind of vicious cycle can come from. The level of layoffs in the economy is below where it was pre-pandemic right now. So when you look at kind of the big factors, growth, inflation, the labor market, I think everything is in pretty good spot at the moment. And that's a nice backdrop. That doesn't mean there aren't risks out there and things, obviously, but I that is, I think, a good backdrop for, let's say, continued positive economic momentum and market momentum.
As I sit at this table behind me, and people always say, well, it's different this time. And I always say it's different every time. And that is so true. We never know where the next volatile market will be. But again, volatility is always going to be there, good or bad. It's going to, but again, it's having that game plan that gets through it, not around it, is the key takeaway.
Yeah. And I mean, the long-term US market return is about 10%. And that's over, I mean, you could think about all the things that have happened in the last 100 years, let's say, and yet the long-term average market return is about 10%. And yeah, clients may have seen there's that classic mountain chart or the index chart, and you can overlay even 2008 or all these different wars and things. And they, when you look at them on a long enough time horizon, they do become smaller blips. And, sometimes I saw an interview one time with Jeff Bezos where he said, I always get asked the question, what's going to change over the next 10 years? I never get asked the question, what's going to stay the same? And I think that second question is way more important. And I think what Jeff meant by that in the context of Amazon's business is that in 10 years, he's not sure what products and services we're all going to want, but he knows we're going to want them cheaper and delivered to us faster, right? Like that is never going to change.
Absolutely.
And I think if you kind of apply a little bit of that same concept to the market, what doesn't change is that in the long term, you're going to get, let's say no guarantee, but the US market average is about 10% return. Right. And, I think you're 100% right. The factors, the risks, like the things that they're going to be different. Those things are going to change. Politics, presidents, ideologies, all of those
policies,
things.
Right.
Policies,
it's all it's always flowing.
Exactly. But if you focus on what doesn't change, I think that's a good way to approach long-term investing.
Awesome. Mike, I want to say thank you for your points and perspective this morning. The biggest takeaway I want to make sure we get out of this, for those who are watching this, is that if you do have questions, concerns, whether you're a current client or a prospective future client of G9 Financial, is to reach out with any questions or concerns you may have. We're more than happy to chat, have a conversation, and provide some insight and some guidance along the way. Our goal is to help those who want to be helped. So please reach out anywhere you can. G9financial.com is the best way to reach us. And Mike, thank you so much for your time here this morning. And hopefully those watching this get to enjoy it.
Yeah, absolutely. A pleasure, Dan. Take care.
Awesome, Mike. Thank you. Bye-bye now.